So for the last few years, I've been thinking dividend stocks are the ultimate wealth building strategy. But then I keep seeing videos, I'm seeing posts saying that they're a waste of time. So am I on the wrong path? Let's break it down. Now, dividend investing sparks a lot of debate. Some people swear by it for building wealth, while others argue it's a complete waste of time. Have you been on Reddit? One of the more recent threads I was reading through said, "Why do dividend stocks have so many haters?" And then there was one that said, "Dividend stocks are a waste of time because," and then you fill in the blank. But is that true? Is there something that they're missing, or am I missing something? Now, after diving deep into the research and all the debates, I think it comes down to two different camps. You've got folks that are diehard growth stock investors, and then you've got folks that are dividend growth investors. So, what side are you on? And more importantly, are you investing the right way based on your goals? So whether you're a new investor or a seasoned investor, looking at your goals is something that you should do periodically as you move through the different stages of your life. So let's break down the difference between growth stocks and dividend growth stocks. And we'll start with the growth stocks. Now, a growth stock is a company that is expected to grow its earnings at a faster rate than the overall market. These companies reinvest their profits into expanding their businesses rather than paying dividends to their shareholders. And they're typically found in sectors like technology, healthcare, consumer discretionary. And there's definitely some advantages of investing in growth stocks. For one, they have a high return potential. Growth stocks can significantly increase in value over time, often outperforming the broader market. They reinvest for expansion. These companies use profits to fuel further growth, leading to potential compound gains for investors. This is long-term wealth building, right? If chosen wisely, growth stocks can build substantial wealth over decades. And they're tax efficient. Since they don't pay a dividend, you don't owe taxes on them until you sell, making them a tax-friendly investment in a taxable account. So what are the cons of investing in growth stocks? Well, there's definitely a higher volatility. Prices can swing widely due to market speculation and investor sentiment. There's no passive income. Since these stocks don't pay a dividend, you're not going to receive any cash flow until you sell your shares. There's also a valuation risk. Growth stocks often trade at high price to earnings or PE ratios, meaning you might overpay for future earnings that might not ever materialize. And market sensitivity. Growth stocks can suffer major losses during market downturns or recessions. Now let's take a peek at the dividend growth stocks. These are companies that regularly increase their dividend payouts while also growing earnings and the stock price. These stocks are often in industries like consumer staples, utilities, and healthcare. So what's great about investing in dividend growth stocks? Well, for one, and probably one of the primary reasons that folks look to these investments is the passive income that's produced. You receive regular dividend payments, which can be reinvested to compound your wealth. There's lower volatility. Dividend-paying companies tend to be more stable, making them attractive during market downturns because no matter the share price, you still get paid your dividend, provided the company continues to pay that dividend. There's also the compounding effect. Reinvesting dividends can accelerate your portfolio growth over time. This is that dividend snowball that everybody talks about. Historically have strong performance. Many dividend aristocrats, companies that have increased their dividends for 25 plus years, have outperformed the market with less risk. Think of companies like Lowe's, Johnson & Johnson, Procter & Gamble. There's also a hedge against inflation. As these companies raise their dividends, your income stream grows, helping to offset rising costs. Now with every pro, there's a con, right? So at times, there is a slower growth potential for dividend growth stocks. These companies often grow at a more moderate pace compared to pure growth stocks. Dividend cuts are possible. If a company faces financial trouble, it might reduce or eliminate its dividend, and there goes your passive income stream, right? This recently happened to companies like AT&T and Intel. In the last couple of years, they've cut their dividends. There's also tax implications, which is definitely a huge topic of discussion amongst investors. If your dividend stocks are in a taxable account, they may be subject to taxes, reducing your overall returns. But if you're here in the States, you can house them in a Roth IRA and avoid those taxes altogether. And finally, These companies may have limited reinvestments in the business. So, unlike those growth stocks, some dividend paying companies distribute cash instead of reinvesting heavily, which could slow innovation for the company. Now, let's take this a step further and compare your options as a shareholder. Let's say you own shares of a company that would be classified as a growth stock. They don't currently pay a dividend. So, if that company is profitable, they're going to retain the earnings for themselves. Then the management team will make decisions about what they feel those earnings should be spent on. Now, when you own shares of a dividend growth stock, the company will retain a portion of the earnings to use as they see fit. But they're also providing a dividend, and you as the shareholder get to decide what you would like to do with your cash dividends. So you can spend it however you see fit. You can invest it somewhere else. You can reinvest in shares or fractional shares of the same company. And this is what we call the Dividend Reinvestment Plan, or DRIP. With a dividend growth stock, the shareholder gets to decide what they do with the dividends they receive. So how do you decide which road to take? Well, I think a lot is dependent upon your time horizon. So let's say you have over 10 years until you're going to need any money. Growth stocks might be a good way to go because 10 plus years is going to give you some time to ride out any potential volatility. But if you want passive income sooner or prefer less stress, dividend growth stocks might be more appealing to you. The longer you hold them, the more your dividends grow, compounding your wealth, creating that dividend snowball that we all like to dream about. Now, a few more things to consider. Growth stocks are going to reinvest their profits, meaning you're not going to see a dime until you sell your shares. These are unrealized gains. It's just on paper, it's a paper gain. Whereas dividend growth stocks pay you regularly. They might pay you quarterly, they might even pay you every month in some cases, and that's passive income coming in for you. Growth stocks often trade at high valuations because investors expect massive future profits. Dividend growth stocks usually have more reasonable valuations, making them a little less risky for long-term investors. So if you do decide to go the dividend route, I do suggest that you do your homework on any company you choose to invest in, and don't just chase the highest yield. A company offering a 10+% dividend might be in trouble. Instead, look for companies with reasonable payout ratios, somewhere between that 30 to 60%. A strong history of dividend increases, like those dividend aristocrats, or even the dividend kings with 50 plus years of growing and paying those dividends. And companies that have sustainable earnings that can support your future payouts, right? Because we don't want those dividend cuts to happen to us. We want to continue to go if this is the choice that you should make. So, should you pick growth stocks or dividend growth stocks? Well, the best strategy might actually be both. And this is actually a strategy that I'm using, where I have a 2 ETF portfolio, a 2 fund portfolio. Growth stocks are going to build wealth fast, but they're riskier. Dividend growth stocks offer that stability and the passive income. And I do feel like a balanced portfolio gives you the best of both worlds, growth potential and consistent cash flow. But investing is part of personal finance. It's personal, and one size doesn't fit all. So what's your investing style? Let me know in the comments. Are you a growth investor, a dividend investor, or maybe a mix of both? And if you're curious about that 2 fund ETF portfolio, take a peek at this video next.